You know, Walt, one of the big debates is whether indexing has won over managed mutual funds. And I'd like to get your thoughts on that. Lately, the indexers have had the upper hand here. They've outperformed the average managed funds.
Sure.
What do you think?
Well, I think it's a point in time, and I would be careful to declare victory on the part of indexing.
So it's not game, set, match?
I don't think so. But in fairness, after the passage of Reg FD that required companies to disseminate valuable investment information at the same time to everyone, post-Reg FD, it has become more difficult for active managers to beat the stock market. And it's not just in the large cap asset classes that many people will acknowledge. It's actually almost everywhere around the market. So as we sit here today, index investing has taken a strong position relative to active, but I wouldn't call the game over yet.
What does Walt Bettinger do with his money? Do you have it mostly in indexed products? Do you have it in actively managed products? Do you put money in individual securities? I'm sure a lot of your money is tied up in Schwab stock.
I was going to say, most of my money is in Schwab stock, but I actually maintain a balance of Schwab stock, cash. I'm always a believer in a meaningful cash weighting, some indexing, and in a few places I'll use active management, particularly in fixed income.
Let's talk about another sort of hot topic, and that is the role of ETFs. They've been a tremendous growth area for your industry, your business over the past decade, decade and a half. And I wonder where you think ETFs are appropriate and best, who they are best for and what, and where you think managed or index mutual funds have the edge. Are ETFs being used broadly, appropriately?
I think they are for the most part, but there's no question in the ETF space, you've got the development of very niche-oriented products, and that's driven by late entrant ETF managers who are not going to take out the big three or big four managing the core asset classes in ETFs. To grow, they have to create a niche product, hope they catch lightning in a bottle, that it gets hot, captures a lot of flows, and then when it turns cold, some of that money stays there. So you've got a little bit of that driven by the firms trying to build their ETF business. We worry a bit about that type of investing on the part of individuals, but I think that's what's driving many of the new building small ETFs today. I wouldn't say, though, that the world of ETFs and mutual funds are necessarily in opposition to each other. I think both will grow and both will continue to be successful. The one area that I think ETFs have not yet made the inroads, and they will, is in your typical 401k. It's inevitable that people who invest more and more in ETFs in their outside assets will start to ask the question, why can't I have ETFs in my 401k? It's been a technology barrier to date. We're working to overcome that. I think that's one thing you'll see change in the next decade.
Because they are tradable minute by minute, are they prone to being overtraded, over speculative ETFs?
Well, you could argue that in some cases, but I don't really think so. So let's talk, for example, about settlement. If you have mutual funds in your 401k, you can trade them every day, right? You can trade actively with those. ETFs have a 3-day settlement. So actually, you can't day trade as much with an ETF in a 401k as you might with a mutual fund.
Let's talk a little bit about one of the broad changes that I think most people in the business expect is going to happen later this year, and that is slowly rising interest rates. Already this week we've seen the 10-year bond go up above 2.2%. That's a fairly significant move.
It is.
How do you think individual investors are going to react to that? Are they well positioned for that? Are they going to be surprised by the effect of rising rates on, most especially, their bond portfolios?
I don't think they will, in that most of the increase is likely to be at the short end of the curve. Now, if you do get meaningful increases in the long end, and you talked about how the 10-year has moved, that's going to create some NAV or net asset value declines, and you could see people in bond mutual funds and bond ETFs wanting to sell if that occurs. That's probably the biggest issue that sits out there. I'm not sure that history shows that equity markets move a lot on the early increases that the Fed might make. But you could see it if the long end of the curve goes up, people wanting to sell. And of course, what is talked about a lot in the industry is, will there be enough buyers at the point in time that those who want to get out of their bond funds or bond ETFs are ready to sell?
Time will tell.
Time will tell for sure.
Walt Bettinger, thanks very much.
Thank you, Tyler.
Good to see you.